Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the second session of the It's Your Money workshop series. The topic for today is Smart Financial Planning, Part 1. Our moderator is Peter Kote, our guest speaker is Thomas Anderson, and this webinar is brought to you by the American Heart Association. Enjoy the workshop.
Thomas, why don't you come online? Thomas is going to be our presenter today.
Good morning, everyone.
Thomas.
Yeah, good morning. Thanks for having me on, Pete.
You're welcome. Why don't we put up your Ask First form and we'll let's do an introduction and then we'll get into the program.
Yeah, let's do it.
Okay, educational background, what is it?
Yeah, so I have a bachelor's degree. I got it from Long Beach State. Actually not in financial planning related at all. It was mechanical engineering undergrad degree.
Well, actually, engineering is a great training for becoming a financial advisor because you look at the details. You're very detailed oriented, and it's definitely not sales.
Yeah, it's not sales. Yeah, and I got a lot of great experience from engineering. Like you're saying, a lot of problem solving skills came from that. So I still find it valuable, even though I'm not using that degree.
Yeah, you've got a credential, CFP. Talk a little bit about what you had to do to get that.
Yeah, I'm pretty excited about that because I got it a week ago.
Congratulations.
Thank you. But it took years of experience. I did it in 2.5 years. Sometimes it takes up to 3, sometimes as short as 2. So I did it in 2.5 years, the experience part, and then there's an education portion. So I did that through UCLA's program. And then there's an exam as well that's pretty rigorous and difficult.
So you passed.
I passed, and so I'm pretty proud to call myself.
Okay. You're working as an associate financial planner. Talk a little bit about your practice and your mentor.
Sure. Yeah. So I work as an associate for a woman named Lori Dubchansky in our practice, Have a Plan Financial. I've been with her for the past 2.5 years. We found each other through doing pro bono together, actually. While I was still an engineer, I did some pro bono help with her through the Financial Planning Association. And then we started working together. So she's the first place that I've worked with coming out of engineering, and I love working with her. I love what we do in our practice because we do everything fee only. We work on
Let's scroll down a little bit. CFP is a private license. It's not a state license. So I think it's more of a credential than a license, but either way, you don't have any FINRA licenses because you have the CFP and you don't sell product, correct?
Exactly. Yeah, I didn't take any of the series exams explicitly or anything like that because a lot of that's covered by the CFP, and we don't sell products, so we don't need some of those other securities or insurance licenses.
And now let's go down a little bit more. You're a fiduciary. You put your clients' interests first. And then how does the firm charge clients?
Yeah. So I personally am paid on a salary, and then the firm level, we charge either through a assets under management fee, which we charge 1% on the first $500,000 and then 0.5% thereafter. And that includes all of our services. So all of the financial planning meetings that we have is included in that. And the other way we charge is just on an hourly rate. So if
Yeah.
people want to come to us for a project, we charge $300 an hour, and we work with people on anywhere from, 1 or 2 hours up to, 10, 15 hours,
And
depending
do
on
you
what
give
people
a
need.
free, somebody says, hey, I'm not sure if I want to be with you all. Do you give a free interview or a free meeting? Excuse me.
Absolutely. Yeah. So we have on our website a link where people can just do a 30-minute phone call. We'll also do like an hour Zoom if people want that, if they want to, see us face to face instead. But either way, yeah, we want to make sure that, it's the right fit for both parties. Is this, going to be the right relationship? So
Do you want to
we don't
scroll
want
down a
anyone to,
little bit more,
yeah,
Thomas, so we can get your address and everything else?
sure.
That's your address and phone number. Um, we're going to go through the financial planning process in just a little bit. Do you have a minimum?
We don't have a minimum, but we do have like a fee minimum. So if anyone has less than $250,000, we still charge at least $2,500 because we need to manage assets. That's just the managing the assets part. But there isn't a minimum
But
of
for an
hours.
hourly, there's no, you give somebody an estimate as to the number of hours it'll take, and then you have enter into an agreement. Is that the way it works?
Exactly. It's just an agreement, not a contract, and it can be started and stopped whenever the person wants. And we really just bill hours based on when we meet with the person and when we're doing the concrete, work for them that they ask us to do, like
And
building a retirement plan.
who's your custodian?
Our custodian's Charles Schwab.
Charles Schwab. How do we fire you, Thomas, if we don't like you after the first couple of months?
Pretty easily, which is a good thing for the client side. But on the client side, they can break that link. Usually, people just would email us if they weren't happy with the services and want to disconnect, and we can pretty quickly within the day disconnect them from us managing the assets instead
Yeah.
of
How do you give or take referral fees?
we do not. So we don't take referral fees from any of the places that we refer out to. We do still, because we're not ourselves selling anything like insurance or annuities, if that ever, comes into consideration for someone, like often we review all their homeowners, auto, all those different insurance policies. We do have people that we know that we can refer them to and guide them along, but we're not collecting a fee for any
So
of it.
the only source for your payment is your clients.
Absolutely, and I think
And how
that's the best way.
approximately how many clients do you have, does the firm have?
Yeah, we have about 60 clients that we manage assets for, and then the hourly side rotates, because people, come and go as they have needs. So I'd say that's another like 40 at any given time. So
Yeah.
around 100 total.
Yeah. Just for Lori Chichesky is on our board of directors at Financial and Estate Literacy. And Thomas and Lori are one of my favorites financial advisors because they take such good care of the clients. And have a plan is not just a business name. It's your mission.
It is the mission. We
Yeah.
want we want everyone to be able to have a plan. I think it's
Yeah.
what sets us apart and makes us unique is that
Yeah.
hourly side.
So this is Smart Financial Planning One. Let's get into the program.
Sure. Share the presentation. Okay.
You want to go? Yeah, there we go. All right. I
I think
love having you have CFP behind your name. By the
I
way, there's
I'm
a
so proud of that. So
yeah,
proud to have that there now.
there's about 140, 120, 140 designations in the financial services industry. Most of them are garbage and you buy them. CFP is not one of those. It's actually a very rigorous course. One of the problems, though, is like one of the questions I asked Thomas, and that was, do you sell product? He doesn't. there's approximately 70% of the CFPs in the country who do sell insurance and annuities. So you need to ask the question, do you sell product? We advocate seeing somebody who doesn't sell product because you don't know whether or not that recommendation is in their best interest or in your best interest. And that's a key. So let's get into the program.
Totally agree. So yeah, today we'll just talk about who a financial planner is, why you should have one, and what is financial planning. I think for me personally, I mean, I was coming from a different career. Growing up, I wasn't surrounded by financial planners at all. My parents didn't have one, so I didn't really know much about this career in general. So I love giving back and doing these kinds of conversations because
You're
for
not
me, I think
getting,
it was eye-opening once I knew
and we're
about
not paying you. You're a volunteer, so we appreciate it.
yeah, I love doing it. But so this first slide I think is so important. So who is a financial planner? Um, all these names here on the left, financial planner, advisor, consultant, all of these are interchangeable. So when you look at someone's business card, you could see any of these names. And the unfortunate part is in this industry, there is no legal meaning behind that name itself.
Yeah.
So
You, you can, everybody who watches this program can call themselves a wealth manager.
right, right, which is a scary thing when we're used to other industries like the medical field, the law, um, having a legal meaning behind when you write I'm a doctor. I can't write that. I can't just put that next to my name. I'd be sued for it. But in this financial planning world, you could put any of these names next to you, have no experience, no necessary credentials,
Yeah.
and still have it on a business card. So it's
That's why we
unfortunate.
recommend using that Ask First form. By the way, how long did it take you to complete the Ask First form?
Less than 5 minutes.
Yeah.
So
Was there anything offensive in there?
no, everything it's super reasonable. It's all
Yeah.
great questions to ask.
Yeah, yeah, it's not just those questions. You need to ask more, but those are the basics. If you don't know those answers to those kinds of questions, get your wealth advisor to answer those.
Right.
Let's
Totally.
go to the next slide.
Okay. So who is a financial planner? So um, financial planners could be working at all these different types of firms. The first, the registered investment advisor, that's something that like Lori and I are. We work for a what's called an RIA. Um, and what's important there is our people working for the RIA are held to the fiduciary standard, and we are charging a fee for a service instead of a fee on a product. Some of these other places where you could be employed as a financial planner, like Pete was mentioning, like a broker dealer.
Merrill Lynch, JP Morgan,
Yeah,
LPL, these are independent broker dealers.
right. And so at the broker dealers, they're going to be charging a fee on a product. So the relationship is different. And so you could find financial planners there. You could find financial planners working at a bank, sitting across from you saying they're recommending a certain loan size. And, you'd think they're on your side because they have the title and they're talking you through maybe a loan for a mortgage. But you have to wonder about where their incentives lie. And for someone working for a bank, issuing a loan, they're probably going to be, not working in your best interest.
Wirehouse, where the Wirehouse is also a Schwab, a Fidelity, a JP Morgan. But what's different between Schwab and let's say a Merrill Lynch?
Just in terms of like size, or what do you mean?
Uh, the Merrill Lynch is more of a full service broker, whereas
Sure.
Schwab is a discount broker that mainly uh, uh, doesn't it doesn't sell a lot of products.
Right, that's true. Yeah. So a place that will sell their own products, they'll be charging, the fee for that particular product versus someone like Schwab might be issuing multiple different products out instead of just their own.
Yeah. Insurance companies are now calling their agents financial advisors.
Right. So this could be insurance companies like annuity provider, um, life insurance provider. Those types of companies will then have financial planners working for them. But again, unfortunately, the issue there is that they're selling a particular product, so the relationship is transactional and not necessarily in the best interest of the person working with them.
Trust companies are different than the others because they're the only other, actually, a corporation that has a fiduciary standard.
Yes. So they have a fiduciary standard. Often they're hired to be the trustee for a client, and work on behalf of that person in a fiduciary capacity. And then they'll handle estate settlement or the management of the assets. So they're going to do more than what a registered investment advisor is doing, but also still held to that fiduciary standard like PIPA.
Yeah, I want to go back to your name is to have a plan, and you can't do a plan if you have too many clients for everyone. And so one of the things you all should ask is whoever your advisor is that how many clients do you have and that you provide service to, and what kind of service do you provide? Let's go to the next slide. We're going to talk a little bit more about that. But first, how is somebody paid?
Yeah, so this is a really important question to ask your financial advisor. And Lori and I always joke that you should ask this question and then you be quiet. And if they talk for a really long time, it's probably not a great answer. Um, but the first way that is on here is commission based. We've been talking about this when you're selling
Yeah,
a
we're going to go
product.
into more of the products that are sold, but mutual funds, partnerships, annuities, insurance, all those products are based sold on commission basis.
Right. And so the relationship then is also transactional because it's not promoting an ongoing relationship. It's promoting selling a particular product in that very moment to a person. And when they walk out the door, the implications of that product aren't necessarily relevant to that, person selling it. It's just they then get their fee for selling it, and the relationship then ends up being very transactional and not an ongoing nature.
So fee based and fee only sounds so similar. What's the difference?
Yeah, fee-based can be confusing because it sounds like you're saying just like fee only, but fee-based is someone who's doing both commission-based structure and doing fee only. So this could be someone who's selling an insurance product on the side and also charging a fee for managing assets. So they're doing both, and so there still can be additional conflicts of interest from being fee-based.
And then fee based on assets under management. Let's say if I bring you $100,000 and for you to invest, let's say your minimum $250,000. What would be my fee on an annual basis?
Yeah, so that fee is 1%. And so it'd be $2,500 for the entirety of the year, and it gets
And
billed
that's
quarterly.
billed quarterly.
Right.
And let's say if at the second quarter I don't want you any longer, do I still have to pay the entire year?
No, we do like a proration of the fee, so it's just to the day that the person requests to, break that relationship. We just calculate the fee as of that day and then send the final invoice for it, and then that's it.
So when you recommend products to a client, do you use commission-based products?
We don't. We use really low cost products because we have the entire universe of products to select from our clients or for our clients, and we are looking out for the best interest of our clients. So we're intentionally choosing low cost like index
And
funds,
and and
ETFs.
low cost products are available to the public?
They are available also to the public. So you can, at custodians like Vanguard, Schwab, Fidelity, there's low cost ETFs available to every person who wants to sign up for them. And so we don't act any different from that. We're not trying to put people in any high fee exclusive products or anything like that.
Does low cost mean less quality? Like that doesn't have the secret sauce that commission products have?
No,
You
it's a good, yeah, good point. It's not. It's actually the opposite, which is kind of counterintuitive. But having low cost and not having to pay the fees for the product um, is actually what ends up having you have performance that's higher than most of the funds out there that have much higher fees. There's plenty of research on that from places like Vanguard and Schwab of showing that paying higher fees for your investment products actually makes you underperform rather than overperform.
Yeah, Warren Buffett said one time, he says, hiring a quote unquote a wealth advisor could detract from your overall net worth.
Yeah, it,
Which is pretty amazing, coming from him.
right. Yeah, I think he also said that when he passes, he's going to just put his the rest of the money and ask that his wife just use the S&P 500 low cost fund as
Yeah,
his only investment.
yeah.
So,
What is a fee-only retainer model?
so that would be you may find a financial planner who's charging for an entire year. They could be billing you monthly or annually, but they're going to be billing for a time-based period.
It's
So,
more along the lines of a CPA or an attorney. There's a,
sure.
let's say somebody who has a lot of real estate and they need help with that. Well, real estate, you can't do an asset under management because you don't know exactly what the value is, and the work is a little bit different. So they use a retainer model.
Right. And this also could be someone who maybe their niche of financial planning is working with younger folks who don't have assets to manage. Because then in that case, they may not be able to pay a fee on asset management that's commensurate with what the advisor, wants, at least for a minimum amount.
Yeah. And sometimes people just are, let's say they're about to retire and they have multiple choices to, if, as far as a retirement plan is concerned. And so hiring a financial advisor either on an hourly or on a retainer basis helps them figure out what's their best choice because it's not easy.
Yeah, no, it's a great point because I think we end up working with a lot of people on an hourly basis just for that reason alone is like people want the second set of eyes. Like there are tools online that you can now use that can try and do what the financial planning software is doing, but if you don't know what's going on under the hood of that software, it can be dangerous to, be doing it yourself. So having a second set of eyes is pretty valuable and
Yeah.
doing it through a retainer hourly is another way of doing it where you don't have to turn over, your assets to be managed.
They say that a general rule of thumb is that if you're working with a Merrill Lynch or a JP Morgan or a broker, your average cost is approximately 3% per year. Of course, that's going to vary depending on the situation, but the average for a financial planner is approximately 1%. But the thing of it is that if you're on the 3% side, it's very difficult to tell what you're being charged. It's not easy to find out. Is it easy for us to find out how you charge, Thomas?
Yeah, it is. Yeah, I think Pete's making a great point because for the Merrill Lynch, if you have the fee embedded in the product, you may never see the fee itself, like very clearly written on a statement or something. But for the fee, when you're working with an advisor who's charging assets under management, you're getting the invoice quarterly that's saying, $500 was billed to your account this quarter. And it's very clearly shown that it's, taken from the account and what that fee is. So very different than when the fee is embedded in the product itself.
Okay. You have business models on the side. We're going to go into that more into the investment world when we get there. So let's go to the next slide.
Yeah. So this slide is talking about who a financial planner is, and how to select one. So some of the credentials that you'd see out there, we've talked about already. The certified financial planner. That's the gold standard of financial planning specialist. There's the rigor behind it from the exam, education, experience. So that's a gold standard. Other ones you might see is CPA. So that's a person who's a tax specialist first. They can sometimes be also doing financial planning and have a personal financial specialist designation. But it's just worth knowing that the CPA's first is tax, and then second, financial planning. And then last, chartered financial analyst, the CFA. That's someone who's goes a mile deep on investments. So their primary focus is on investments only. They're not going to be talking about a lot of the other financial planning documents or topics like retirement, insurance, estate planning. Those aren't things that a chartered financial analyst is going to be specializing in. They're really only going to be digging deep into your investments. Most of them end up working for much larger firms and manage products like ETFs. So they're not usually someone that you're hiring to manage your investments necessarily.
Experience.
Experience is really important. So that's something that you can see on, if you go on, there's certain websites. I should post them down there, but you can look up a person's experience and see how long they've been working in this industry. Very important. Rapport and trust. I think maybe the most important of all of these. Do you have that relationship with the person? Do you want to work with them for a long period of time? Ideally, all the financial planning relationships are long term. So you don't want to work with someone that you don't like. So
Yeah, this is a marriage. You want to really understand the individual, and the rapport is so important. Trust. People don't like to talk about their money. They don't talk about it with family members. But you have to, when we get into the whole area of the financial planning process, we'll get more into this. But suitability and best interest, you're the best interest standard. Is that correct, Thomas?
yeah, actually, I think that those are kind of interchangeable now. But the it's fiduciary versus best interest. I'll tweak that on the slide here, but they changed the standard from suitability to best interest just a few years ago. So you might hear that a person is under a best interest service model, but they'll be working for someone like a broker dealer. The issue with that is best interest sounds nice, but best interest is very, very loosely defined. And
Yeah,
so they may not actually be working in your best interest. You
yeah,
want someone working under a fiduciary service model.
yeah. They made it more confusing. Independent custodian, why is that important? Bernie.
Um, yeah, Bernie Madoff is a great example of this. So independent custodian is that middleman. So in the Bernie Madoff situation, there was no middleman who was holding the assets. Instead, Bernie Madoff was collecting checks directly from people and having people's assets directly in his own accounts.
Yeah.
The
Let's go to
issue
the
with
next.
that is when you might request your money, it may not be there because in the case of Bernie Madoff, he was, it was a part of a whole scheme. Um, in the case of advisors who have an independent custodian, your assets are at that custodian, and the advisor only has a power of attorney to come in and make trades, charge their asset under management fee, but they can't do things like take money from your account.
No.
Any kind of wire or transfer all has to be approved by you. So
Yeah.
you want to make sure someone has the independent custodian, that middleman.
So let's go into the next slide.
Yeah. So here's some great reasons for why you should have a financial plan. I think the first is defining financial goals. Often, people come in and they may have like a question on one, specific topic in their life, but then through just having a conversation with the financial planner, that'll help uncover all those financial goals that they have and help point them in the right direction to fulfilling those goals.
Well, it's kind of like when somebody comes in, what do you ask them to bring in to the first meeting?
Well, truly, in the first meeting, nothing. Like in the very first one, we just want just them. Like we want to understand who they are. We want to
Okay.
know everything about your background, your family history, your life, your values, like what
When
you,
you look at the
yeah.
portfolio, when they bring in the portfolio, when you review it, do you ask why they have what they have?
Yeah, we will try and start uncovering that too. Like I think everyone has their own different philosophies, right, on how their investments came to be. And so it's important to figure that out and figure out,
Yeah,
okay, is
because
this,
does it
oh,
meet with your goals? You know, what are
yeah,
you trying to accomplish?
exactly. Exactly.
Eh, so are we going to go into, you going to have a separate slide on goals, or is this going to be the it on the how important goals are?
I think there might be one more slide on it.
Okay, okay, let's move on then.
Yeah. So, some other reasons helping people align their spending with the goals. I mean, just the spending alone. I think we find often that, people spend without necessarily thinking about how much they're spending. So, working with a financial advisor and getting a financial plan, they're going to help you like figure out, okay, how much can you spend given the resources that you have, the income sources that you have. Um, Help you actually summarize how much you're spending currently. That's, I think, super valuable. We recommend tools like Monarch that aggregate all of your spending into one place so that you can then see all the data and how you spend in different categories. That's, I think, super super valuable. Um, Shows you any money mistakes you're currently making. Uh, uh, Allows you to measure your progress and your goals, find new ways to maximize your money, um, identifying risks. I think we talked about that a little bit earlier, but we're often in a full financial plan reviewing people's different liability insurance policies, making sure they have enough coverage, identifying risks in their investments. If they, have too aggressive of a portfolio for their risk tolerance, we don't want, someone going in and out of the market. Um, Helping you be more confident with your money, uh, and helping you live more comfortably. I think the confident and comfortably are so important because I talked about it a little bit earlier, but the second opinion gives you that confidence to say, yes, I can retire. We sometimes have clients come to us who are 2 weeks after retirement and say, oh, is this going to work? And that's a little scarier than when people come, a few years before and we help them build up and get confident that they can meet their retirement.
Would you say a good financial planner is a good number cruncher?
Yeah, absolutely. And we use software as well as an aid in that number crunching because there's a lot of complexity with it. You're aggregating all these different investments, all these different income sources, all these different goals and spending,
Your
and
age,
your age and putting it all into one planning software to do projections that are 30, 40 years out that include compound interest and taxation and all these different variables like inflation. So there's a lot of numbers behind the
complexity.
financial plan, and
Yeah.
making sure you have it set up right is important.
Yeah. And as soon as you put the plan together, it's probably out of date. So,
That
uh,
is true.
so it's really important to have the longevity with a client so that after 2, 3 years, you can see whether or not there's progress.
Absolutely.
Yeah,
Totally agree.
and if somebody wants to do it themselves, sh can they? I mean, is it, it's hard to be objective, but you definitely should write down your goals and, you definitely should know how much you spend on an annual basis.
Yeah, I think a lot of that stuff people can reflect on and do on their own. I think the only thing that I think is difficult to do on your own without a second opinion is the full retirement planning projection. Unless you're gonna like really get into the weeds and read up about all the different, variables that go behind a retirement plan, that's a really challenging one to do on your own. There are
What so-
softwares out there to do it, but it's just hard.
what software do you use in your practice?
We use a software called Money Guide Pro,
Okay.
and that's our retirement planning software.
Let's go to the next slide.
So we've been talking a little bit about why a financial plan is important. So what is included in the financial planning process?
Before you go on, Thomas, we got a question that says, I am retired. I need a lawyer for the trust. Do I still need a financial planner? Why not just put everything in the S&P 500? Be easy, and would that be a good solution?
Well, think it depends. Like, do you need to align investments with some goals and some long-term planning? Like if, resources that are had are not needed, necessarily for the long term, like when they're for like a inheritance or a gift for future children or something, maybe it's simple. Maybe you don't need the full financial plan for it. But if you're trying to balance between like how much can I spend from this trust and um, all of that, I think it's valuable.
Yeah, and it's also, what are you spending enough? People leave a lot of it goes back to what's your goal? What are you trying to accomplish? So you got to write those down, right?
You do. Yeah. And then I think on this slide for me, what stands out is I think when people typically think about financial planning, they think right immediately toward investment planning. They think, how do I, get my investment allocation appropriate? How do I, make my money grow? How do I protect it? And that is all super important. But it's just, one bullet on the, 10 bullets that are up here of what the full financial planning process is about. It's
Yeah.
really about,
The
yeah,
If you got an IRA, how much should I take out of my IRA? Should I take out the minimum one? What if I got a son or a daughter who wants to borrow money? Should I lend them money? How should I do it? If I got a mortgage, should I pay off the mortgage? Should I not pay off the mortgage? In buying a car, should I lease or should I purchase it outright? There are so many financial decisions that you make during your lifetime that if you don't have somebody to talk to, you don't know what a good answer might be or looked at all the potential alternatives. You
right.
know, uh, uh, Maybe the S&P 500 is not appropriate for you because the S&P 500 are the 500 largest companies in the world, and that might you maybe you need more diversification than that. How do you determine your risk to get your return? There's uh, cash flow and budgeting. How much time do you spend on cash flow and budgeting?
We spend a good amount. I mean, it's usually right in the beginning. We talk about it and we kind of see like, is this person spending more than their resources, like more than their income? And then try and help them figure out why. If sometimes it's the opposite, like you mentioned, where someone might not be spending enough and they actually have much more than they maybe realize. And we can provide that confidence to say, yeah, you can spend a little bit more. Like you have the resources to, improve your lifestyle, take that
Yeah.
trip, take that international vacation.
Yeah, and just the encouragement because the biggest worry that people have is running out of money or not having enough money to maintain their present lifestyle.
Right. Yep. And
And
then I
and
think
how you feel and the actual numbers a lot of times don't match.
absolutely. Yeah. And I think one other bullet on this slide that's important is the tax planning side. Often, people think that their CPA is doing the due diligence to do all the tax planning for all their future years in retirement, where oftentimes the CPA that you're working with is worried just about the current year that you're in, and sometimes, filing taxes to get you the biggest return in that present year. Working with a financial planner who has the appropriate tax planning software and knowledge can then give you recommendations that may be a little bit counterintuitive to what a CPA is recommending in 1 year, but is better for a much longer period of time.
So you work with the CPA, you work with the attorney, you work with the insurance agent to make sure that somebody's life is financially healthy, so to speak.
Absolutely. Yeah, it's like I feel like the financial planner is like a captain of a football team where there's
I,
a lot of other players on the field who are, part of the full financial planning process. And the financial planner is kind of that like central role to like bring everyone together and get everyone talking to each other, get the a tax attorney or, CPA and the attorney, insurance all talking together to make sure, all of the different parts of their life are aligned.
yeah, you want to make sure, do just from a tax point of view, we want capital gains kind of income in our for taxes. So we don't want a lot of churning of accounts. We want the 15% limit on dividends from stocks. We want to know whether or not to do a QCD, a qualified charitable donation out of your IRA. You got IRMA, your Medicare. Like, what do you do there? There's so many issues involved in managing money.
There are. Yeah, and I think it's unfortunately complex. I think it's why the financial planning industry exists is because we have all these different networks of, financial decision making to make across all these different bullet points on this screen. And
Yeah.
unfortunately, it is complex.
And that's why the question before from the individual who said, gosh, if I put a trust together and invest all my money in S&P 500, I don't need any other advice. Well, maybe you don't if you've got all the other issues covered, but I would say there's a lot of questions that you need to have answers to. And let's let's go to what in your practice special needs situations. Talk of just about a few to give us an idea of what those are.
Yeah, so that could be someone coming to us and saying, we have a special needs child. What's the best way to set that up? And really, I mean, we're not attorneys, and so we are not setting up special needs trusts or anything like that. But we might refer out to an attorney who could help set up that so that resources can be saved into an account that's separate from being included in the calculations when the government is paying out benefits to that special needs person.
Do you include family members in with the clients as to helping them pick out who should be the next trustee or who should I pick to do whatever?
Yeah, I mean, we welcome it if people want to bring their children into meetings. We'd welcome that. We don't necessarily like seek it out. I think we often when we are doing our like estate planning review, we're looking at those things. We're seeing like, okay, who is a trustee of your account? Sometimes we're flagging things like the beneficiary of this account is a person who's passed away. I think you may need to change this. So we'll flag things on the estate planning, but we're not attorneys, so we are often referring out to have people set up, trusts and work with an attorney for legal counsel.
And do you cover all of these issues in the first year of having a client come in to you and at first, or does it take a number of years to get a kind of a complete plan?
Yeah, I think it's all depends on the cadence of the person and how quickly and they want to go through this. But usually we
Hey,
tackle the stuff that's like most important to them first. we identify our own things that, we think are, high issues, like on the insurance side, someone having bare bones minimum, California auto insurance coverage, while we're living in a state that every little thing becomes a liability. That's a high risk for that person. So we would identify that and make that an early priority.
You know,
But
one of
anything the person comes to that's their highest priority, we tackle that first.
there's a speaking of insurance, uh, so you review their homeowners and auto insurance with the client?
We do. Yeah,
And
we
then
review it.
what is an umbrella policy, and would you recommend that for most individuals?
Yeah. So the umbrella policy is, you can think of it literally like the umbrella um, sitting over your home and auto, policies. So in that case, it's providing that extra bit of liability coverage if your liability exceeds what's on your homeowners or your auto policies. The umbrella kicks in to provide additional coverage. Very valuable because it's not very expensive, but it gives you that extra layer of protection. So usually it's like $300 to $400 for $1 million of umbrella policy coverage for a year.
Just so for everybody, we're going to spend an hour and a half on the investment side of it. So we're not going to go heavily into that. Let's go into the next slide.
Yeah. So this is a good self-assessment quiz for, do I need a financial plan? So some of this is, are you planning for the future? Do you need funds set aside to, replace your income from work to provide financial independence? Setting aside education funds for either yourself, a child, grandchild, other lifestyle goals like long-term care. Do you need money set aside for that, or do you prefer insurance, or um, other questions on here? Are you properly diversified? I think this is one we talk to a lot of clients about because they'll often come to us with really, really concentrated positions in a couple companies.
Do
And while
people
that
understand risk, investment risk?
sometimes not, especially when it's that concentration risk, when it's like a couple companies that you have that they sound big and great, like an Apple or an Amazon. Um, that even though that those companies are great, they may not be the best investments long term.
Yeah,
Uh,
we're gonna get into that, but diversification is a real key issue in managing risk.
right. And then is the overall strategy tax efficient? We talked about that earlier on the tax planning side.
Yeah, municipal bonds, or do you get corporate bonds? I mean, do you take more money out of your IRA one year? Do you do a Roth conversion? How about gifting to kids? Uh, Tax strategies it should pay just in for fees alone because just to properly talk about just one strategy, tax harvesting, which is coming up probably in the next month or two. What is that?
Yeah, tax loss harvesting is for every year. You are allowed, if you have $3,000 of capital losses, you can use that $3,000 capital loss to offset your income. So it depends if you have losses or not in your portfolio. Losses are not great, of course. Like, we're not trying to lose money intentionally just to get a tax deduction. But if you happen to lose in one particular part of your portfolio, you can sell that part of your portfolio as long as you don't buy it back within like a 60-day window. Then you can use those losses to offset, income on your tax return. So
Yeah. So in your balance sheet is really important to know what your cost basis is of a particular asset and what the market value is. And so, just because when you sell an asset, you're going to pay a capital gain. And so, a lot of times, a financial advisor at the end of the year will sell some of your losses and then sell some of your gains, and to offset to any kind of tax issues. And the whole idea is to increase your cost basis. So if in the future you need to sell a stock, you pay less in taxes. And you got to have software, I think, for that to do that efficiently. But it's a strategy that if you have a sufficient sized portfolio, if you don't have some losses in your portfolio, you probably don't aren't totally diversified. Not
Sure.
everything goes up every year.
True.
Protect yourself, my family, and property against risk. Are you talking about the umbrella policy to see if you're properly insured?
Yeah, yeah. So that's the insurance. We were kind of touching on that already. Um, so then assets passing efficiently to my heirs, like, do you have the right beneficiary designations? Do you have a trust set up? Do you need a trust? Do you at least have a will set up? So those are questions to ask yourself. Uh, what legacy do you want to leave? Do you want to be charitable? Do you want to leave to children? Um, yeah, those are all questions to ask yourself.
Yeah, and explore.
Yeah,
And it's hard to explore these areas on your own. I think you need somebody. I think a fee-only financial advisor has to be a good listener and almost a therapist on the money side
it
because
is
money.
true. I mean, we talk about that the financial planning relationship is mostly emotional rather than technical.
Well, there's a whole area of the financial world called behavioral finance. What is that, Thomas?
Yeah, behavioral finance is the study of the different, um, I don't want to call them issues, but like the different ways that people make behavioral issues regarding their money. So, are they like too confident in their money? Are they taking too much risk? Are they, yeah, not taking enough risk? So, yeah, it's a study of all the different like behavioral issues with money.
Yeah, it's so it turns out that our little brain P called the amygdala in our brain reacts in a Neanderthal way to news about money, that we emotionally get involved in our money decisions. And emotions are, our mind sometimes is our worst enemy when it comes to making investment decisions. And where do we learn about money anyway? I mean, just certainly not in school. And it's almost like the road of hard knocks. And if we read the newspaper every single day or watch media, or we would think everything is going to hell. Um, have you been getting calls regarding the government shutdown as to what's going to happen to my portfolio?
Yeah, we get those calls all the time. Like, how's this going to impact me? Oftentimes we are saying we're staying the course, right? Like we're trying to align people's investments with their goals and the appropriate time horizon so that when, things like this do happen, it's, well, I have my short-term funds for, the next few years. I don't need to change my long-term part of my portfolio because, that's for the long term. It's not for, a government shutdown.
Yeah.
But
So
I think it still stresses people out and they want to talk through it. And we're there to be that person to talk through these things and talk through how they're thinking about it, their emotions around it, listen to them, understand, um, and hopefully come to an agreement not to make drastic changes.
I find a statistic the other day that 80 for those individuals who are 80 plus, that 30% of us will be have some kind of mental decline. And so Alzheimer's or dementia, etc. And the and when we get there, it's difficult for us to manage money because it's complex and we're subject to scammers. and we answer the phone and we shouldn't have, and we get involved in something. I think as we get older, the fee only financial advisor is so important because you've got somebody that you can call, that you can trust and say, hey, is this make sense? Should I do this? And to help out the individual so that they make good investment decisions. And we live in Orange County here. We are the scam capital of the world because this is where the money is. And older people have the money. And so please be careful out there. Let's go to the next slide.
Okay, and then we'll go into how the financial planning process works. This next few slides is set up by the CFP board. So when you work with a financial planner who's a CFP, they should be following a process like this and communicating to you these different steps. So I'll just kind of go through it, what this
Thomas,
process
I'm going
looks like.
to interrupt you, and we
Yeah.
got a couple of questions. One is they're saying one of the questions is State Farm is no longer offering umbrella policies, and do you know of any? Can you recommend any other companies that might be?
Yeah, I think we've been seeing Mercury has been doing umbrella policies.
Auto Club, has Auto Club been doing umbrella policies? Do you know?
I'm not sure if they have,
Okay,
but
but
yeah,
check with them.
if your provider is not offering an umbrella policy,
Yeah.
it's worth, you know, contacting
Changing.
an insurance broker to
Yeah.
see like, okay,
Yeah.
is there any other, types of companies out here offering the
Yeah,
umbrella?
I personally have Geico, and they're not offering an umbrella policy because I live in a fire zone, so it makes it quite difficult. So it's really a good question. Don't fall in love with your insurance company, please. Uh, Check it out, others. And I know it's a hassle, but I would, it could save you some money and it could give you better coverage. And there's another question. Can you please share references or guidelines on how much you should have for retirement at 40, 50, and 60? I've heard you should have 6 times your goal income. I'm going to stretch that question out. How much does the rules of thumb really help an individual?
Yeah, I think it's so unique to each person. So it's hard to use rules of thumb. They exist out there. There's one that's called the 4% rule that, gets talked about all the time, which is pretty much saying at the start of retirement for a 30-year period, you could withdraw 4% of your portfolio safely over a long, 30-year period of time without, potentially running out of money by the end for a 50% stock, 50% bond portfolio.
Yeah.
Um, so that's a rule of thumb that's been out there a while, which mean you would need to have at least somewhere between 20 to 25 times your income needs in retirement in order to safely, make it for a 30-year period.
Yeah. And at 40, 50, and 60, the question becomes usually savings. But how much are you spending? And what is your goal that you want to spend in the future? Some people want to be a multimillionaire. Other individuals just want to make sure that their spending is met, that they do on an annual basis. It's really an individual thing. If somebody just wanted to come in for a financial plan, what would that cost, Thomas?
Usually
Approximately?
that takes around like 6 hours. So for us, it's around like $1,800 to.
Yeah. Yeah. It might be worthwhile for you to do that. Rules of thumb, we're all so individual, and how we spend money, how we save, and it's and I would suggest a financial plan. So let's talk a little bit about the process.
Yeah. So this is what's outlined by the CFP board, the financial planning process. So first is understanding the client's personal circumstances. that's what we were talking about at the beginning, where we're sitting down with the person, we're trying to understand them before really diving into any of the numbers. We want to know your goals, your values, and then we could start like uncovering some of the financial information. So we do that through collecting financial documents and then kind of combing through those documents and putting it all together into a planning software. But that's how we start the process. And then second is identifying, selecting goals. This is kind of an ongoing conversation with a person because goals change, people change, but we're trying to put together like what are your current goals? What are we,
You got to write them down too.
yeah, what are we trying to allocate resources to?
Because when you review a plan or you review your investments, you got to go back to your goal to see whether or not you made progress to that goal.
Yeah, absolutely. Um, and then the next is analyzing the current course of action, potential alternative course of actions. Um, this is that like what if, like so you're on this current course. If you did nothing, this is where you're going to end up. And then here are a bunch of like what if scenarios of what if you saved more? What if you spent less? What if you retired later? What if you retired earlier?
What if my stock market goes down for another uh, um, 20%? What's going to happen to my portfolio?
Exactly. Yeah, and what's going to happen to your plan? And so that's the stress testing part. Um, and so during that stress testing, then it's developing the plan recommendations. This is not just the investments, like I talked about earlier. This is everything. This is the, insurance, tax planning, uh, retirement planning. All the recommendations are included in this step. And then, so that's behind the scenes. We develop that. We use a planning software, and then also just use like an agenda in order to write down the recommendations for when we're going to communicate it. uh, and then the next step is presenting. So this is when you then have your next financial planning meeting where you're sitting down and we're talking through all this stuff, making sure all the assumptions in the planning software are correct. We have all your investment accounts correctly, all your sources of income, all the goals that you want, and then refining it and going through it together to make sure it's what you want. Um, and while we're presenting it, then that's when we're sending like a list of recommendations. Number 6 is the implementing part. So when we're giving those recommendations, it's communicating who's doing what. Are
So
we
let's say, for instance, what mutual funds to purchase, uh, uh, in what category? Is that the kind of thing that we're talking about?
Yep. Yeah. So it could be like if we're, in an assets under management relationship and we're recommending a particular portfolio and it's agreed upon, then we're going to be the ones implementing that and making the portfolio changes. For something like your insurance, we might be then just sending that to you. We might be helping you get a quote from another person, but really that final implementation is going to be on the client to make those changes because we're not going to act as like on behalf of them to get their insurance for them.
Okay, or even in the tax area, you may say, talk to the CPA and see if you can bunch some of your deductions in this year versus next year. Maybe use a donor advised fund in your strategy. So it's not just investment in implementations, it's tax, it's legal. Hey, you need to update your living trust and your advanced healthcare directive. It's it's to implement the recommendations that you have made based on the information that you got from the client.
Right, right. And then the last step in this process is monitoring and updating. So this last step is it's not mandated and it can be communicated beforehand. Is there going to be updates? So like for us in our hourly relationships, we may be working with someone over a project in a short period of time. But that relationship may not be ongoing for multiple years. It could just be just for that moment in time. So that monitoring progress and updating isn't there unless that person's coming back to us and saying, "Hey, I want to look at this again because my circumstances have changed. The financial plan is outdated." Like Pete was saying, it outdates itself almost the moment you walk out of the office because life happens and things change.
But
Um,
if you have a pattern, if you have it over a 5-year pattern, you could see your spending. But if you don't put a plan together, at least do yourself a favor and put a balance sheet together. And so once a year, at the end of the year, you at least put a net worth statement so that you could see where you are. Because if you listen to the news and everything else, you could be feeling like, hey, everything is going to hell in a handbasket. But if you run the numbers, you go, hey, my net worth hasn't changed or it's actually increased. So the focus should be on you, not what's out in the world.
yeah, I love that idea. I love the idea of writing down the net worth every year.
Yeah, it's just you can see whether or not you're making progress or no progress, or if you're going down too fast in your net worth, you may need a financial advisor sooner than later. But we don't monitor ourselves very well. It's
Right.
kind of like monitoring our weight and health. We need to do the same thing with our money. Let's go to the next slide.
Okay.
By
Yeah, and
the way, we've got 10 minutes left there, Thomas, and so I don't know how many slides you have left, but
I'm going to use this one as the last slide,
okay,
since we touched on all those topics here. But
okay,
these seven, there's a slide for each of them that you guys can use if you download the presentation. But I'll use this as like the last slide since we already covered all that.
okay.
So this is kind of to wrap up what we were talking about earlier, establishing that relationship with the CFP professional. So use the Ask First form, such a valuable tool to just get some basic questions answered about how they get paid, what their background is, what their experience is, what
What kind of
licenses they have.
licenses do they hold? They
Yep.
hold an insurance license. You've got to question that. Do most people in their 70s or 80s, 60s, 70s, and 80s need whole life insurance?
Yeah, I
I mean, the
not
answer,
necessarily.
no,
Usually
not
not. So
hardly ever. Do most people need annuities, commercial annuities? And there's most of us don't.
right.
So if you have an insurance license, you got to question the potential conflict of interest.
Yep, it's true. Yeah, and you can ask them even that question directly because all of the financial advisors' conflicts of interest will be written down in what's called their Form ADV, and that should be published on their website, should be published with the SEC or the state, um, and it will explain exactly what their conflicts of interest are, and they are required to explain those to you if you ask. If you are asking what conflicts do you as an advisor have, everyone has some type of conflict of interest. Like for us, I know one is that we use Schwab as our custodian, and we get technical resources because of that. And that's a conflict because we could be, with a different custodian, but we are with Schwab because they give us great resources, great technical resources to help our clients. But
Does,
that's
what- does,
conflict.
Schwa- does Schwab charge extra fees to you or to the client?
No, they don't charge additional fees. Yeah, I mean, they have fees in their just in the spread between the bank sweep account, which isn't earning a lot of interest versus other products that they have. So if you're invested with them and you're in something like a bank sweep account, it's going to earn interest similar to what's like you know, one of those big banks for a checking account. And so because you're not earning a lot of interest, then they're able to earn a little more on their own. So
Yeah, the
you don't
most
want,
money these institutions make is from clients or from individuals who keep a large sum of monies in no interest bearing accounts.
Yeah.
So, what do you usually suggest if people keep in a checking account? 10, $20,000 or
Yeah,
uh,
whatever you need for like just a couple few months and like whatever you feel comfortable in order to pay bills for a few months at a
yeah.
time.
Keep the rest of your money into a money market fund that is paying at Schwab, I believe the Value Advantage Fund is paying 4% and over.
Yep. Yeah, those funds are getting interest that you normally wouldn't get with like for instance, I use Bank of America for some of my banking. They pay next to nothing. They pay like 0.05% on their checking accounts, and
Yeah,
it's
yeah,
almost so small that you don't even have to file it for taxes because it's so tiny the amount of interest you earn. But if you then move money to places like Ally or Schwab and earn money through their savings accounts or money market, you can get 4+ sometimes percent,
yeah.
which is
And your last point, does your financial understand how you like to communicate, and make decisions? Super important. Some people like to be contacted once a month, or once a quarter, or once a year, and it changes over time. But I I just want to get a financial planner is for all financial decisions, not just the investment. The investment, if we know how much you're spending, we know how much risk you want to take. A financial advisor can put an investment portfolio together for you. It's the apple rolling off the cart. It's not, that's the simple part. The hard part is getting together your information. You know, what's your risk tolerance? How much do you spend on an annual basis? Uh, those are the hard parts. And how do you think financially? What is your financial brain about? And all of us are different in that regard. So how you communicate is really important, and how you make decisions. If I talk to somebody who have lived through the depression and I mentioned that we're going to put some monies in the stock market, my gosh, it's kind of like, let's go to Vegas and roll the dice. And so, but your advisor needs to know you and your family situation. Let's go to your slide that gives your contact information.
yeah. I might have one. I don't know if I have one on here. Yeah, I don't think I have a summary.
Okay, the Ask First form will
Bring
do
up your
it.
Ask First form.
Yeah,
Yeah,
I can do that.
and just put your contact information there. And in fact, if Don, could you put his contact information in the chat box, or can people see everything in the chat box or not?
They can see it, yes.
Okay, but we don't want them to go there.
But it's right there.
Okay, it's right there. Anyway, we want to
I
open
can't
up.
I can't type that well or that fast, so it's right there.
Okay.
Sorry.
Okay. All righty. Let's open it up for Q&A. Any
Before we do that, what I'd like to do is, because we don't record the Q&A, so what I want to do is to say thank you to Thomas, and thank you to you, Pete, and thank you to the group for having been here with us. This is Financial and Estate Literacy. There you go. Thomas can type. Financial and Estate Literacies. It's your money session number 2. Next week we will talk about
medical
talk
care
about
planning?
medical care planning. And I thank you all very much. And Thomas, why don't you stop sharing your screen? There you go. So again, Thomas, thank you very much. Pete, thank you. And I'm going to stop the recording.